Hello and welcome. This is India Markets Open. I am Agam Vakil and with me is Mathew. Hi, Alex.
Good morning, Agam, and good morning to everybody tuning in as well. One could go so far as to say that this is a historic day. I don't remember the last time there was a trading session on a Saturday.
A whole trading session? Yeah. No, I don't remember that either. Sure, we've had a bunch of trading sessions happening on Saturday, but never a full trading scene going on as far.
And it's going to be a busy day if you can think about the major cues, right? So you have Reliance Industries earnings to take into account, you have HUL earnings to take into account, and two major banks that will be reporting numbers at the very least today. So it's going to be a busy day.
Yes, absolutely. And we're certainly going to take a look at a whole host of cues that are playing in favor and against markets. But Alex, why don't we start with the global cues and what they're selling us?
Absolutely. So at the end of the week, you had Wall Street that ended on a high. So you have the S&P 500 that hit an all-time high, Agam, and it was gains of about 1.2% that helped the S&P 500 erase the losses from earlier in the week. And if you remember a headline from Thursday, it was the Taiwan Semiconductor company, which essentially gave a very bullish outlook going forward, as a result of which a lot of the AI-related stocks, generative AI-related stocks, and the tech stocks in the US rallied very strongly. That rally continued into Friday as well, and that helped all of the three major benchmark indices gain ground. The tech-heavy NASDAQ, in fact, gaining as much as 1.7%. In fact, one of the cues that has come in from research by Societe Generale. They've said that hedge funds hold the highest level of net long NASDAQ futures in as many as 7 years. So that indicates that bullish momentum could potentially head into next week as well. A few of the other aspects, there are still uncertainties regarding the pace of rate cuts by the US Fed. Of course, a lot of those expectations have pulled back over the past 10 days or so, and that has panned out in both the bond markets as well as in the equity markets. However, overnight, you saw the 10-year yield in the treasuries in the US stay more or less flat or unchanged at 4.1 or thereabouts. You have crude oil prices, which have largely been unchanged as well, and that is despite geopolitical tensions continuing to be at the forefront. You have the latest update, which is that the US as well as the UK are contemplating ways to step up their campaign against the Houthi militants that have disrupted trade because of that passage in the Red Sea being affected. But having said that, you have Brent crude that is still around that $78 per barrel mark.
Right. So, Alex, when it comes to our own markets, at the moment, one might argue that yesterday was a little bit of a pause in the kind of correction that we've seen over the past few days. That said, while the Nifty did advance by around 0.8%, the Bank Nifty, while it traded by higher in the green through the course of the session, it eventually gave up all its gains and will eventually end it in the red. That perhaps is something that could be a concern as far as the markets are concerned going forward, because any sort of strength is sold into. Now, at the moment, the other aspect when it comes to the range is that, well, at least as far as the Nifty is concerned, on the higher end, we continue to keep an eye on 22,000, which seems like a far cry at the moment, considering we have seen so much writing around that level. But on the lower end, earlier in the session yesterday, we had a base formation around 21,000, but that has, of course, moved up at the moment. And right now, we could perhaps see some amount of support around 21,400, 21,500. Remember, when it comes to FIIs and index futures, in the session before, they were 49% long, and now, yesterday, their long position will reduce further to just about 47%. This also means that there certainly is a little bit of caution as far as markets are concerned. And while the Nifty put-call ratio continues to remain below the mark of 1, it's fairly neutral, so I don't want to talk too much about that at the moment. But in terms of direction, there is no doubt about the fact that there certainly is caution at the moment. And it will take a lot for the bulls to even start off a round of short covering at the moment, Alex.
No doubt. And HDFC Bank, we've been focusing on it all of the last three trading sessions. In fact, I do not know if we can pull up the ADRs, but overnight you saw still another drop in HDFC Bank's ADR. This is, of course, the stock price here in India, but you saw about a 1% odd drop in the ADR overnight. ICICI Bank, on the other hand, saw pretty strong gains on the ADR ahead of its results later today, and we'll talk about that in just a bit. But let's focus on a few of the stocks that you should watch out for in trade today. We were talking about Reliance Industries being one of the key monitorables today, and that's because they posted their results for the third quarter after market hours yesterday. Let's look at the headline numbers. You have consolidated revenue, which stood at about 2.25 lakh crore rupees, and that was an increase of about 3%, or rather there was a decline of about 3%, and it was below consensus estimates, not by a very large margin, but it was still below consensus estimates. EBITDA has come in at about 40,650 crore rupees, and that was also down about 0.8%, but margins have actually come in ahead of consensus estimates at over 18%, and that's despite the drag of the oil to chemicals sector. And again, we'll break down the numbers for you before the start of trade as well, and we'll also get you the analyst perspective on how to read Reliance Industries numbers. As a result of all of that, the net profit number has come in lower by about 0.75% at 17,265 crore rupees.
Right. Well, of course, the other big number from the Nifty 50 space, and of course, one of the largest consumer players is Hindustan Unilever. Again, we were expecting a disappointing quarter, and that's exactly what we've got. We're looking at flattish movement when it comes to its revenues, so largely a less than 1% decline as far as revenues are concerned. And this is on the back of a 2% growth as far as your volumes is concerned. Now, that, of course, doesn't augur well, and even though the street was working with anywhere between a 0% to around 3% growth in terms of volumes, it's perhaps bang in line and very much within that range, expected range. Net profit, on the other hand, did advance but to a certain extent, but this is the interesting figure, right? Well, volumes coming in at around 2% against a 5% on a year-on-year basis, and well, naturally, the challenges that the company has faced when it comes to the rural sector, the rural areas, the rural segment is something which is weighing on the company. And if it's weighing on Hindustan Unilever, we can only expect that this is also going to, well, impact several of its other peers as well, especially given the fact that Hindustan Unilever is a pan-India player with substantial distribution across the nation. So it is something that could perhaps, well, see a little bit of reaction, even though these numbers are largely in line with street expectations, Alex.
Absolutely. There was also Paytm, which posted its numbers post-market hours, and it did report a net loss. On the revenue side, it has registered a gain of about 13% or thereabouts, and on the EBITDA side, it's registered an EBITDA loss of about 159 crore rupees, and that is wider than the consensus estimates, which had pegged it at around 50 crore rupees of an EBITDA loss. However, the net loss has actually contracted in the quarter gone by. It stood at just about 220 crore rupees, and that compares with consensus estimates of over 250 crore rupees of losses. So that's one to bear in mind as well. It's not had the best ride over the last 3 months, and it has in fact lost ground, down about 20% for that period, but certainly one to watch out for. There was also, of course, RBL Bank, but remember, it was a result that was announced in the last few minutes of trade yesterday. In fact, let's pull up yesterday's intraday chart, if that is at all possible, and we saw a bit of a cut towards the end of the session. Maybe that will be in focus at the start today as well, as investors and traders take into account the numbers for the quarter gone by. I did look at one figure, Agam, that I did not mention, or that rather that we did not look at, which is the flows, right?
Yeah.
And we've been looking at that very closely because on Wednesday as well as, or rather on Thursday as well as Friday, you saw quite a bit of, or rather Wednesday and Thursday, you saw quite a bit of selling, 20,000 crore rupees by foreign institutional investors. Yeah. That number stood at about 3,700 odd crore rupees on Friday as well. So they're not stopped selling.
Absolutely. And of course, a lot of that, a big chunk of that was HDFC Bank, but there's no taking away the fact that they are in fact net sellers at the moment in the markets. In terms of stocks that we're going to keep an eye on today as well, we're going to have earnings from Kotak Mahindra Bank and ICICI Bank, besides the relatively smaller public sector banks like Union Bank of India and IDBI Bank. Remember that while both Kotak Mahindra Bank and ICICI Bank have not fallen to the tune, the correction seen by HDFC Bank, they are still weak. And in fact, Kotak Mahindra Bank has not moved in perhaps years, no more. It's been around the same level in well over about 4.5 years, if I'm not mistaken. And ICICI Bank, while it has appreciated over the past couple of years, we are looking at a little bit of a dip coming through on account of its larger peer. And this kind of selling that's coming through. Besides that, we're keeping an eye on Persistent Systems. This is one of those companies, one of those mid-cap companies, which has seen a lot of interest from funds as well as a lot of PMS houses. This is also one of those companies where your earnings would tend to be lumpy, but that's not the case anymore ever since we've had the new management come in. And, the things have smoothened out a bit. But that said, we still are anticipating a little bit of weakness when it comes to the US markets. Can that weigh on Persistent Systems? That is something we will know somewhere down the line today. And besides that, we're keeping an eye on Jammu and Kashmir Bank. This is the one bank that I could not mention earlier, but this is one of the biggest movers in the year. In the last 12 months, in fact, it has outperformed all the other PSU banks significantly. And I think there are all sorts of guesses around turnaround in the bank as well as its operations, which is why there has been so much, buying action as far as J&K Bank is concerned. So we'll be watching out for that one. It's going to be another interesting one to keep an eye on, Alex.
Certainly. And a few notifications, Agam, that have come in, corporate updates, if you will. Messages sent to notifications sent to the stock exchanges. I will take you through a few of them, and that could have a bearing on trade today. HFCL, on the one hand, has received an order worth about 623 crore rupees from a telecom service provider for the supply of 5G telecom network equipment. So that's certainly one to watch out for. You have Z Entertainment that has sent a clarification. And by the way, so HFCL was active in trade yesterday. Z Entertainment as well losing ground on account of a media report that spoke about the possibility of Sony International calling for a board meeting to discuss the future of the acquisition, but Z has clarified and said that they are unaware of any board meeting that is taking place at Sony India. Pratap Snacks also in focus. The company has issued a clarification that says that it is not in negotiations with Haldiram for a stake sale. It was quite active in trade yesterday. And Fortis Healthcare has told the exchanges that its unit Agilis Diagnostics has received a notification or notice from Delhi's Anti-Corruption Bureau in the Mohalla Clinics case. But Agam, what can you take from the F&O cues heading into trade today?
Right, it's going to be an interesting day of trade. We are going to see a reaction of Reliance Industries and HUL on the Nifty 50. And based on that, at least as far as yesterday is concerned, as I mentioned, we were looking at the index higher by around 0.8 of a percentage point. And we didn't see too much traction as far as open interest is concerned, but the Bank Nifty was a completely different picture, which gave up a lot of its gains it made through the course of the day, eventually closing the day in the red, and open interest looking at a little bit of decline, which means some further unwinding as far as the Bank Nifty is concerned. What about your option levels at the moment? As I was suggesting earlier, that while on the higher end, 22,000 remains the one with a max OI, we're starting to see the little bit of a shift on the higher end, on at least as far as the bottom end of the range is concerned. So we did see that max OI shift from 21,000 to 21,500 at the moment. That's where you're seeing max OI in terms of puts. Now, yesterday, we did see the Nifty advance. Naturally, that means that we also would have seen a little more writing around the puts, and that's exactly how things have panned out. Puts being written around 21,500, 21,600. Let's move on and talk about stocks and take a look at how things are panning out there. Reliance Industries was one of the big movers in terms of open interest change. So we'll be keeping an eye on that one. Of course, we'll react to earnings today. Apparently, longs there. Longs in Titan and ONGC along with Tech Mahindra, and Gujarat Gas looking at some short build-up, and short covering for Aarti Industries, Atul, PNB, and India Mart Intermesh. RBL Bank, on the other hand, looking at longs unwinding. So this is as far as the stocks are concerned. The question really is that, with the kind of data that we have, an unprecedented whole trading day on Saturday, what can we do with this data and how do we take things forward? Well, we have Aditya Arora of Analytics, who's joining us in the moment and who can perhaps help us decipher these cues. Aditya, good morning and thank you so much for joining in. What are you making of the benchmarks and what are you making of the Nifty and the Bank Nifty at the moment?
Very good morning, Agam, to you on a Saturday morning. It's a very different experience when markets are open on Saturday. And the data which I'm reading on Nifty and Bank Nifty is that FIs and institutions have been less bullish than they were a week back. So we saw a stellar rally from almost 16,000 to 22,000, wherein FIs were aggressively long. Now they are taking chips off the table. They're less aggressively bullish on the market. And, the data isn't so positive. So market may react to global cues and markets may inch up, but that wouldn't have a lot of fuel to add to the rally. So I think all the bounces on the market are actually a selling opportunity before the event like budget and Ayodhya. So all these events are adding fuel to the rally, but those wouldn't be actually an opportunity to go aggressively long, but actually build some short position or write some calls. I think those calls could turn to zero in some time.
Right. Aditya, let's talk about a handful of trading ideas then. I believe you have one on TCS. Can you take us through that?
Yeah, so tech has been a sector which has stood out in this fall. If you look at the chart patterns of TCS, then it didn't participate too much in the fall and actually inched up and bounced back very aggressively when market turned sideways or rebounded. So I think there's a long way to go on the upside, and here put writing could be a good strategy. Currently TCS is trading at 3943. So over here 3900 put could be sold, which is trading at 19.70, and stop loss here is 40 and target is 0. So that's a bullish strategy on TCS.
Right, and I believe you also have one on Tech Mahindra.
Yeah, Tech Mahindra. Exactly. If you look at Nasdaq yesterday, then it inched up very aggressively. And I think this sector hasn't participated in rally at all. So Tech has some juice left. So again, in Tech Mahindra, we can sell 1370 put option, which is currently trading at 19.70. 40 should be the stop loss and 0 would be the target. So it's a bullish strategy on Tech Mahindra.
Okay, so those are two calls from the IT space. And of course, Aditya has already mentioned his strategy and how the way he would go about trading the benchmark indices. On that note, Aditya, thank you for joining us and taking us through your views as well as giving us a handful of trading ideas. And with that, it's back over to you, Alex.
Absolutely. So those are interesting cues to take from the F&O space, of course. We are focusing on Reliance Industries in a great amount of detail. And in fact, we will break those numbers down for you. By the way, I have a note from Citi that talks about Reliance Industries. It has downgraded the rating on Reliance Industries to neutral from buy, with a revised target price of 2,910 versus 2,600 earlier. That earlier target has been taken out. And remember, Reliance Industries has been instrumental in the last moves for the benchmark indices that took it past that 22,000 mark. In fact, it's up as much as 18.5%. But what are they saying? What is Citi saying? It has raised its FY24 to 26 EBITDA estimate by 2 to 5%, which is led by Jio as well as retail and O2C. And it believes that the stock's recent outperformance makes the risk-reward more balanced. But let's go across to my colleague Vikas Srivastava, who's looked at the numbers in a lot of detail. And Vikas, my question to you is very simple. There's a lot, of course, to look at with regard to Reliance Industries, so many businesses to take into account. But what, according to you, are the three most important factors to bear in mind?
Yes, Alex, as you rightly said, 2 or 3 key takeaways from the earnings were, like if you look at the oil to chemical segment, that has underperformed. It is one of the major contributors to the revenue, almost more than 50%. So that underperformance has affected the profitability as well as their revenues. So this underperformance has mostly been because of the major shutdown which has happened at their refinery and petrochemical units. So this was for almost 2 weeks. So that has affected them, as well as the price realization has been weak compared to the previous quarter. This has affected their gross refining margin as well as the petrochemical margins. However, this underperformance has been offset by strong performance from the retail and the telecom sector businesses. Retail has grown by almost 7% for both revenue and EBITDA, mostly because of higher footfalls in a festive quarter. So their revenue is almost 83,000 crore rupees, and their EBITDA is also almost 6,280 crore rupees in this quarter. As far as Jio is concerned, in Jio the revenue and EBITDA has again done well compared to the OTC segment. That's mostly because of higher net subscriber addition during the quarter.
Right.
Although the ARPU is stable compared to the previous quarter.
Right. Vikas, thank you so much for getting us that roundup of how Reliance Industries has done. But to discuss this further, we're also in conversation with Sushil Choksi, is the CEO of Indus Equity Advisors. Sushil, good morning and thanks for joining in. Let's break this up when it comes to Reliance Industries. Want to understand first your take on the oil and gas business. How has the petchem business done and how are you assessing the performance here?
Good morning and thanks for having me on the show. I think Reliance result was stable as per the Bloomberg estimate and market participant estimate. If you break up the division-wise profitability and PBDIT, oil and gas has done exceedingly well as they've ramped up the production. Oil to chemicals and petrochemical fiber intermediate division has done marginally lower compared quarter on quarter, purely led by maintenance shutdown. But if you divide product to product as per the investor analyst meet, some have gained, some have been lower, but they're expecting the Chinese and the Asian demand to keep margins at a stable level. And the problem in November, December was more led, which was not highlighted, but more which is in the press, about shipments of diesel going to Europe led by the Middle East crisis, specifically the Red Sea. Now, looking at throughput, it is clearly indicated that the closure led to a marginal decline in the profit. But if you look at the cash profit being churned out by the division, stays elevated. And second thing, Reliance Capex in this quarter was lower than the cash flow they've made of 32,500 crores. So I think it was a very pretty stable number, and Reliance focus and investment of last 5-7 years between retail and telecom has started substantially showing a sign of betterment. The growth is visible in top line and EBITDA margins as well as EBITDA. Once the entire expansion plan is over in few weeks and few months, as being spoken about, the footfall, the spend of Indian consumer would start setting that Reliance capability on retail and telecom both same. Now they've done the pan-India 5G, but their ARPU and that they're still rolling out a plan based on 4G.
Sushil, on that point, right? So you have a larger contribution by retail, and this is Alex joining in, Sushil. Retail as well as Jio contributing more, particularly retail on account of those higher footfalls, and that is visible in the margins as well. If anything, they've come to the rescue on the margin front and resulted in a better than expected margin performance. Would you then, taking that into account, adjust your own expectations for the performance of the stock? It has gone up quite substantially in the last 3 months.
Ultimately, Reliance today may have 70-30 between oil to chemical and a consumer play. It's a clear indication which the chairman has guided that consumer and they would be equal, and a time would come where consumer would overtake. But you know, the India consumption story and India play, be it oil to chemical, plastic, polyester intermediates, fiber intermediate, fiber, is all a consumer play of India. So if India does well, this division is bound to do well and they'll throw a lot of profit. And the cash profit has aided Reliance for the entire expansion of last 2 decades. The similar way, the investment which has gone in retail and telecom will start showing, and everybody expects, whether it's 3 quarters, 3 months, or 2 years, 3 years, the story of unfolding about retail listing and geo listing, because they've already done a PE infusion and sovereign funds investing in these two arms. So it's a matter of time that we'll have to, instead of 1-3 listing and market, they've already listed the financial services. So it's a pure play on India, and you have to look at the consumer behavior in India consumption story and look at it. And chemical has contributed in a bigger way because of exports and import parity replacement for domestic market. Second thing, the second half of...
Right. I think we have a problem with Sushil's line, but I think we would want to thank Sushil for joining us and taking us through his views and what he makes of Reliance Industries quarter. It's time for a quick break, but we leave you with what the HUL management had said about segmental volume as well as revenue growth. We'll be right back.
On inflation, within foods and commodities, what really impacted us was fresh milk, which impacts the impact on Horlicks, both skim milk powder over a long-term period, and fresh milk, because when you consume a cup of Horlicks, apart from putting Horlicks, you also put a cup of milk into it. Within food commodities, coffee and sugar have seen inflation. In fact, coffee, when you look at last 2 years, cumulatively is a 70% inflation. And which is why, as we have taken price increases, not to the peak of inflation, but we have taken price increases to respond to this high inflation. We have seen growth in terms of business. So our coffee business grows in double digit, but it has led to impacting of volumes, and volumes have declined. Similar has been the impact on HFD as well, where we have seen growth, but volumes have declined. That is the overall impact of commodity, which I spoke about in terms of F&R business for us. Now, skim milk powder has started to moderate compared to where it was, and year on year now we see, in fact, small decrease. Tea commodity overall, we had spoken earlier, has moderated for last 2 years. In fact, we've seen deflation in tea commodity, but there the market is downgrading to plainer teas, to the loose teas. So there's a mix of commodity inflation and downgradation, which has impacted. Now, as we move forward, the point I was making earlier, inflation has moderated in foods commodity as well now. And hence, going forward, if at all this situation continues of commodity, this moderation will help volume recovery. The way we have seen in 3 quarters of the business, home care and beauty and personal care, where we are now seeing in our business mid-single digit volume recovery, because there's a meaningful correction which have happened in commodity cost. That has helped us to take prices down, and we have seen volume recovery. That should also happen in times to come for the foods and refreshment business as well.
Welcome back. You're watching India Market Open, and we're just seconds away from the pre-market open. It is, of course, a novel experience to be bringing you markets on a Saturday. You have the first few ticks that are in and not really all right. So you have a little bit of chop and churn. Remember, we're not expecting there to be very large amount of volumes in trade today, but we're settling in the green. At least the first few ticks are in the green. To talk about things, and we'll bring you back to where the markets settle in the first few ticks, of course, but let's talk about what we have in terms of cues. And we're joined by Parthiv Shah, Director at Tracom Stock Brokers, as well as Sudeep Shah, Deputy Vice President and Head of Tech and Derivatives Research at SBI Cap Securities. Parthiv, novel experience speaking to you on a Saturday with the markets open. We've got quite a few major companies to focus in on, and we've spoken about the results for Reliance Industries as well as HUL. What are you most focused on at the start today?
Good morning, Alex. Oh, yes. Yesterday evening, I actually had to double check with my staff that I just wanted to ensure that they're not joking, because we knew there was a morning 2-hour session for the disaster recovery, but for the entire day on a Saturday, I think first time in my career it's happening. Anyways, yeah, lots of results yesterday, Alex. One of the results that I would like to highlight was that of Ultratech Cement. I think in terms of the volume growth coming at around 5% on a very high base, because the base is around 21-22 million tons. I think I feel it's a very decent set of numbers, and this is despite the fact that there were some challenges in some of the key pockets. But despite that, a 5% volume growth, along with, I think, operationally fantastic numbers in terms of the EBITDA, which is at 1,200 rupees EBITDA by ton. The street was somehow penciling around 50 rupees lower than that, but I think Ultratech always delivers its best in terms of operational efficiency, especially when the energy costs are lower, the raw material input costs are lower. And going ahead, the guidance that this company is able to give in terms of the volume growth, thanks to the fact a lot of organic and inorganic capacities will come on stream. So there are kind of phase 1 is almost coming to an end in terms of its capex, post which phase 2 and phase 3, which adds another 45-50 million tons. I think that will really kickstart in terms of further re-rating of the stock. So eventually we are looking at Ultratech over the next 2 years to be almost a 200 million ton cement company, which will be the only company in the country to have this sort of capacity. And the second competitor being the Adani Group is still, I think, will have to catch up. But anyways, I think Ultratech Cement looks very good. In terms of the other numbers, I think HUL, according to us, were pretty weak because frankly speaking, I think in terms of the volume growth, they've been struggling since a very long time. Yes, there are talks of green shoot in terms of the winter crop recovery from the rural. Unless and until the rural kickstarts and HUL delivers a volume growth of around 5-6%, I really doubt if there's any further re-rating in the stock because it's already quoting at around 52 times FY26, which is pretty hefty for such growth. So we would prefer to avoid HUL at this juncture.
Parthiv, stay with us. We'll also get in Sudeep Shah of SBI Securities who will join us. Sudeep, good morning and thanks for joining in. Let's start with your view on the markets, perhaps the Nifty. Where are you seeing it head? Because, we saw a little bit of a divergence yesterday. While the Nifty stayed in the green, the Bank Nifty eventually closed in the red. What are you making of these cues?
Good morning. See, what has happened yesterday is while we saw Nifty, both the indices had opened with a gap up yesterday. However, Nifty still managed to close with 70-80 points gain, but you saw Bank Nifty completely selling off. This is I guess largely because still there was some bit of selling visible in HDFC Bank. Along with that, what was important is that ahead of ICICI Bank's numbers and Kotak Bank, street is a bit apprehensive of what the results could be, and that is the reason we saw some kind of nervousness ahead of that. And largely, I feel levels now from a Bank Nifty perspective, important levels will be 46,100, 46,200 on the upside. Now, these levels need to get crossed, and till this does not happen, it could trade with a negative bias and probably retest levels closer to say 45,200 or 45,100, where the 100-day moving average is placed. So I feel overall Bank Nifty could be in a range between 45,200 on the downside and 46,300, 46,350 on the upside.
Fair point. Thanks, Sudeep, for bringing us that or giving us that view on the Bank Nifty. We have spoken about quite a few of the results that have come in post-market, but there are a few of the other companies that we've not spoken about. And we've got Anushi joining in to tell you about some of the details there. Companies like CESC, as well as Tejas Networks and Credit Access Grameen, as well as Suntec Realty from the Realty Pack. What can you tell us, Anushi?
Right. So now if you come to CESC, the company has reported about 4% revenue growth at rupees 3,244 crore. But it's the EBITDA and the profits which took a beating, with the EBITDA being down about 30%, while its EBITDA margins were down about 519 bips at 10.6% compared to 15.85% it had reported last year. Other than that, the net profit was also down about 10%. Apart from the result point, the company also included an interim dividend of rupees 4.5 per share. Coming to Tejas Networks, the revenue was up about 103% at rupees 560 crore. But the EBITDA loss widened at rupees 7.51 crore compared to a profit of about 8.01 crore last year. Talking about the net loss was also at about 44.87 crore compared to a 15.15 crore earlier. Next is Credit Access Grameen, which has seen about a 42% uptick in its revenue at rupees 1,292 crore. But other than that, its net profit was also up about 64%. The company has also mentioned that they are going to do a fundraise of up to rupees 2,000 crore via the non-convertible debentures route. And last on the list is Suntec Realty, which came out with a quite disappointing set of numbers over here, with the revenue being down about 53% at rupees 42.4 crore against the projection of about 137 crore. EBITDA loss was at 114.82 crore against a profit of about 18.03 crore last year, and the net loss widened at rupees 9.7 crore compared to a 2.1 crore of profit earlier. So these are the 4 stocks that you should be focusing on its results.
Anushi, thanks so much for getting us those updates from this quarterly earnings. Parthiv, good morning. This is Agam. What are your view on what you would do with companies like Kotak Mahindra Bank, ICICI Bank and Axis Bank, especially keeping in mind with what's happened with HDFC Bank? What's the way forward when you consider these top 4 banks here?
Good morning, Aga. See, Agam, the challenge for the banking sector this quarter, as they're already attributed the last quarter, was the compression in the NIMs. And it was evident in HDFC Bank. There is some struggle in terms of garnering the liability franchisee, which is the lower cost deposits. And despite the fact that the disbursement growth has been pretty steady and pretty high, I think a lot of that growth is coming on the back of funding from the high cost term deposits. So that has been the key challenge, and we are expecting the same to pan out in ICICI Bank, Axis Bank, and even Kotak Bank. Kotak Bank is something where I think now, thanks to the fact that the management issues are settled and we have a new CEO, MD CEO, our sense is that it could be a challenging next 1 or 2 quarters, but the valuations haven't been as good as what it is right now for the last 5 years. So we are tempted to look into such pockets. I think it's historically, if you see in the private sector banking space, such are the times to accumulate these quality names, because eventually when the FPIs come back strong, I think they are surely going to buy into these stocks as and when the float also increases. So we are upbeat on Kotak Mahindra Bank, and along with HDFC Bank, we'd like to see ICICI Bank's results because I think the valuations are on the elevated side. So if the results are in line, we'll take a call on that. But otherwise, HDFC Bank and Kotak Mahindra Bank would be our favorites on any declines.
All right. I'm also curious on the real estate space, Parthiv, and what you think about that, because we just saw Suntec results, and I think this is one pack that has gone from strength to strength, though you've had a little bit of a wobble in the recent past. What do you make of the top companies in this space, and what are the cues that you're taking? Are you sanguine based on the pre-sales data that seems to be getting everybody excited?
Oh, yes, Alex, absolutely rightly pointed out. I think the pre-sales data, along with the fact the momentum in the residential, especially the luxury and the upper luxury, I think is something what people are taking notice of. And a lot of pockets, important geographical pockets like Gurgaon, Bangalore, Chennai, even Bombay and Pune. I think a lot of these companies which have very strong geographical presence out here, they've been doing extremely well. And if you look at the valuations, they are pretty elevated. A lot of these real estate developers are talking of that there is still this good structural story. The real estate cycle doesn't kind of end very soon. It's been after 10, 12 years that we are witnessing such real estate cycle, thanks to the fact that now there's a lot of funding available for home buyers. We are seeing great traction. But I think the pocket that I would like to look at is in Ahmedabad. One, I do have a bias because I'm from Ahmedabad, but I'm seeing tremendous development out here. And two companies that come to reckoning. One is Ganesh Housing. We saw stupendous performance and the type of projects that they're putting in. And despite all of this, despite this recent run-up, is still quoted at a trail P multiple of only 13. And the visibility going ahead is looking fantastic. So these are these 3,000-4,000 crore market cap stories in Ahmedabad, which I think could grow to 10,000-15,000 crore over the next 5 years. We also like Arvind Smart Spaces. I think the type of horizontal real estate development that they're doing and the pipeline of projects that they have, not only in Ahmedabad, but even the Bangalore pocket, our sense is these are the type of companies now investors should look at, which can really scale up over the next 5 years.
All right. So that's the view as far as the housing sector goes, real estate specifically. But Kotak Mahindra Bank is in focus, as the company is set to announce its results soon. And the net profit of the company is expected to be up as much as 13% in the third quarter. We have my colleague Pragati, who's joining us to give us an update on what we could potentially expect from its third quarter. Listen in.
Now, Kotak Mahindra Bank is on our radar as the lender is expected to report its third quarter earnings on 20th January, which is a Saturday. Now, while there are a couple of things that we are tracking in these earnings, here is what the analysts are expecting in terms of the numbers. As far as net profit goes, the bank's net profit is expected to rise approximately 13% to 3,163 crore rupees. The net interest income is expected to rise approximately 14%. Asset quality, which is a very important metric, especially in this quarter for the banks, which has largely also been pristine for Kotak Mahindra Bank, is also expected to be in control once again this time, according to analysts, with gross non-performing asset ratio GNPA expected to be around 1.66% as opposed to 1.72% in the previous quarter. Now, this was what in terms of the numbers are expected for Kotak Mahindra Bank from the analysts. Other things that will be key and to watch out for will be one, the bank has a new MD and CEO in Mr. Ashok Vaswani, who took charge on 1st January 2024, and he will also be addressing the media on Saturday, which will be his first official address to the media. So we'll be bringing you fresh updates from there, definitely. Next thing, the management's commentary on margins, credit costs, and the deposit growth will also be something to watch out for in this quarter's earnings.
All right. But I want to go across to Sudeep on HDFC Bank, arguably one of the stocks that has decided the course overall of the benchmarks as well as the Bank Nifty over the last 3 sessions. The question is, does that continue today as well? Sudeep, what's the view on the technicals with regard to this particular counter?
Alex, if we see this chart of HDFC Bank, whether it is daily, weekly or monthly, it's a big sell candle now. What has happened is that almost that gain from 3rd of November till now, till 5th of Jan, so almost 2 months of gains have been wiped off in just 3 to 4 sessions. And now this stock is very close to its November swing lows of 1460. So it's just 10 rupees away from that. And I feel if this is broken, where even the 200 DMA is also close to 1430. So I guess if this zone of 1460 is breached, the first important level would be 1430. But below that, the supports are quite steep, which could be around 1370, 1360 also. And in the last many years now, except that I guess April 2022, where we saw a big fall from 1700 to 1300, HDFC Bank has never fallen in this magnitude. So this is something serious, what I feel with respect to the bank and the selling pressure that the market participants have been observing in this stock. So I feel it's a bit premature that we should start adding these names. Just wait for a while, wait how the stock is shaping up. Maybe levels closer to 1360, 1390 zone, another 4-5% from here, we could start dabbling into it. And this could be added from a SIP mode and just not from a pullback perspective. And in comparison to HDFC Bank, if you see Axis Bank ICICI Bank, those names have been outperforming till now. And in the last few quarterly results also, if you see post results movement,
Right.
ICICI Bank and Axis Bank have always outperformed.
Sure. Sudeep, stay with us. We have the market open with us at the moment as we speak, and we're likely to see a positive start as far as the benchmarks are concerned, at least if something is to go by with respect to the pre-open. What we are looking at right now at the moment is a little over 0.25% up move as far as the Nifty is concerned. Well, pardon me, in the pre-open it did move about 21,700, but that's not been the case as far as your overall opening is concerned. So the Nifty, okay, sure, we're now around 21,700. That is a positive. As far as the Sensex goes, again up around 4.4%, around 72,000 level, and the Bank Nifty is now once again starting to see a little bit of an up move. Remember that we had seen the Bank Nifty come off by quite a bit yesterday, but it seems like it's showing a little bit of an advance coming through. The mid-cap index outperforming the benchmarks, up around 0.9%, nearly 1%, and it is the same for the small cap index as well. That's also up and about by around 0.7%. Let's take a look at the Nifty heat map, and it does look like a great heat map, because we're looking at, well, just 2 losers out of the 50 stocks out here, 48 advancing. And even though the top gainers like Power Grid, NTPC aren't advancing by well over 1%, we aren't really looking at too much loss here. Marginal gains for something like a Maruti Suzuki, TCS. Reliance Industries is something that we will be watching out for. It's up around 0.6%. Hindustan Unilever, on the other hand, declining by around 2.5%. And that was, of course, also perhaps expected after the kind of earnings that we saw. Ahead of earnings, Kotak Mahindra Bank again marginally in the green, as is the case for ICICI Bank. So we continue to keep an eye on a whole host of these counters. I reckon that through the course of the day, as and when we get more earnings, we will also have a reaction of sorts following those. So keep an eye on, well, a whole host of these banks, which perhaps still set the tone to a certain extent as far as markets are concerned. But for now, well, green across the board, Alex.
Absolutely. I'm looking at some of the counters, Agam, from the broader markets as well. And first, let's talk about some of the big gainers, right? You have, again, from the real estate pack, you have IRFC, which is gaining ground once again today. It's going from strength to strength, this particular counter. It's up as much as 8% today as well. And you have a few other counters, RVNL, for example, that's gaining about 7.5%. Engineers India up as much as 6% or thereabouts. HFCL, we were talking about that order win earlier before the start of trade. It is up as much as 5.8% or thereabouts. Sterling and Wilson also gaining about 5% or so. Among the key losers, and not too many to speak of, or rather not too many very large losers to speak of, HUL, of course, Agam already pointed out, is a bit of a disappointment on the Q3, down about 2.3%, and it's holding around that level. Tejas Network is down about 4.9% or thereabouts at this juncture. CESC also losing ground after its Q3 numbers. It's down about 3.5% or thereabouts. Suntech Realty, we were talking about the fact that it's a bit of a disappointing number, is also down about 2% or so. Going back, Parthiv, to HUL, you were pointing out that the volume number was a bit of a disappointment according to you. What do you expect going forward, though? And I think that is something that the street is taking into account. The stock is down about 2% or thereabouts. I guess to a certain extent that was anticipated. But does that change at all? Does that consumption story change at all? What are the key cues that you would watch for?
See, frankly speaking, I think in terms of the two business verticals, especially the beauty, personal care and home care, I think which brings in almost 75% of the volumes, I think there's been a lot of weakness. And the weakness is not only attributed to the fact that the rural economy brings in the weakness, but also with huge competitive intensity coming in from likes of ITC, Reliance Retail. And, you know, we should acknowledge the fact that even Reliance type of companies like Reliance Retail also have a lot of private label, which give a lot of substitution products to the consumers of HUL. So I think the competitive intensity has gone up. The weakness in the rural is impacting. And I think no doubt HUL in the past has recovered from such such cycles. But currently, I think looking at the valuation at which HUL is quoting at, I think I'm more tempted to look at other options like ITC, where they have very strong cash flow generating cigarette business, along with the fact that the FMCG is also scaling up well. I think it's quoted at around 28 times forward vis-a-vis HUL, which is quoted at 52 times forward. So I think there are always better valuation pockets in place to play the recovery in FMCG vis-a-vis playing with HUL.
Sudeep, I come to you on the two calls that you have with us this morning. One of them is Cummins India, which is around about where we closed off yesterday. But you also have a buy on NBCC, which has shown some amount of strength. So in terms of levels, are you making any changes? Can you take us through both these calls now?
Yeah. So if you see NBCC, this stock has given a good momentum in the last few days, and all these CPSE names have also given good momentum. So while we see NBFC specifically, the stock was in on a daily as well as weekly chart, it is in an uptrend. The weekly, if you see the weekly chart, higher top, higher bottom formation in the last 4 weeks have been observed. But looking at the daily chart after say 6-7 days of consolidation, we have seen the stock gain momentum say on Friday from the lows of 87. Right now it's around 96, 97, and I feel that till the time the levels of 92 are not broken on the downside, this stock could head up to 103, 105 levels, and it's in a strong uptrend. So even this could be bought on dips today with a stop loss of 93 with a target of 105. The second stock which we discussed about is Cummins. Now, Cummins, if we see post some kind of a consolidation in the last 1.5 to 2 months, now it has given a firm breakout on the upside, and the stock is now sustaining above all its previous swing highs also. So on a daily, weekly chart basis, the strength is obviously there. The stock is even sustaining above its shortest moving average, which is 10 and 20-day exponential moving average. So even from the current levels, I feel this could be bought with a stop loss of 2060 and a target of 2250 on the upside.
Okay. All right. Parthiv, I'm actually curious about Zee Entertainment. There's a lot happening with regard to this counter, right? And a lot of questions that are still unanswered. The latest update, of course, end of last week was that the Sony board could be meeting to decide the course of the partnership and whether or not that takes place. We could hear as early as next week, according to that news report. But the company has come out and said to the exchanges that it is not aware of any such board meeting and that it is still committed to the deal. What do you think should be done with this counter? Would you wait for clarity, or would you say that both entities are likely to bury the hatchet, so to speak, and move forward with the deal?
See, Alex, very frankly speaking, I think this is not a counter for the faint-hearted because I think it's almost like a binary event where I think what the street wants and what the market is expecting is that if Mr. Punit Goenka were to kind of move on the side or resign, I think that will be a huge trigger for the stock because the market feels that will pave an easy way for a merger with Sony. And I think Zee on its own, I think it will be very difficult to grow. Not only that, they have inventory issues and they will need an infusion of cash. And Zee on its own, on a standalone basis, I think I doubt if they are in a good ability to raise any sort of cash from the market. It will take Sony's merger because Sony's merger will bring in almost $1.5 to $2 billion worth of cash that Sony has, which will bring in also a lot of synergies in terms of the channel networks that both the companies have. So with a merger, I think the price goes a lot higher, almost $100 more from here. But without a merger, I think I won't be surprised if it goes down by $50 to $60 from here and settles there. So it's a binary event, not for the faint-hearted, but I think it will be interesting to watch out how things pan out in Zee Limited.
All right. Sudeep, wonder your quick view on Hindustan Unilever. How would you go about this one?
Yeah. So if you see HUL, now HUL in the last 3 days has been on a downtrend. We've seen some kind of selling pressure also there. And even on the weekly charts, last 3 weeks, it has been lower top, lower bottom formation. But largely the stock is trading in this range between 2450 on the downside and 2700 on the upside. And now it is approaching the lower end of the range. So I guess it's a range bound stock closer to 2450, 2460. It would be a good entry point, because if you see the overall FMCG index, it is not doing too bad. And steadily stocks are moving out of their range on the upside. So I feel overall HUL also around 2450, 2460 could be a good entry point. Right now it is under a bit of selling pressure, but closer to that zone where always the selling pressure is absorbed. So one could look as a good entry point towards 2460, 2450 levels.
Okay. Parthiv, I'm curious about your view on the downstream oil companies as well. We saw a little bit of action towards the end of the week, or rather the traditional trading week. They are up and about in trade today as well. 0.5% for HPCL, about 0.8% up for HPCL. BPCL, I'm getting the two confused. But having said that, Parthiv, what do you make of these two counters, and what are the major cues you'd focus on?
See, Alex, I think interesting moves of late. The stocks have gotten re-rated, deservingly so, because I think just 6 months ago, these companies were quoted at abysmally low valuations. Forget India, but rest of the world also, if you were to compare, and even if you were to compare kind of markets like Brazil, China, I think these companies were quoted very low. Not only that, they've gotten re-rated, but I think now what is keeping the investors on the edge is the fact that probably, I doubt if it will happen, but I think probably the market is sniffing something like a cut from these OMCs in terms of petrol and diesel prices to the tune of almost $5 to $10. And if that were to happen, I think it were to happen with a cost to these companies. So that is what probably is spooking the market, because I doubt if the government would be in any mood to rationalize or lower the excise duties, but the burden would be borne by like kind of all these OMC companies. So that is the only negative that probably one can wait out for the next 2 to 3 months. Post which I think the outlook post elections also, I feel, for these OMCs looks very good, because the valuations are still extremely compelling.
All right. Parthiv, in what areas are you seeing most amount of value in? Potential opportunities which could possibly do very well going into the next few quarters and perhaps this entire year?
Yeah, we surely are looking into the private sector banking space. We just discussed that because I think the valuations, if you look at the last 5 years, haven't been such attractive. And with the GDP growth, I think the credit disbursement is going to take place. And yes, they will have to sacrifice the NIMs, but the operational profitability we are expecting to go up. We are also looking at some of the PSU pockets, especially the EPC based or the manufacturing based names like Engineers India Limited still has a long way to go. The type of orders that the company can execute and take. We are also looking into names like PTC India, which is very interesting power proxy play. We know so much of things are happening in the power sector, but PTC is a fantastic power proxy play, quoted very cheap at around 12 times forward. They also have a power exchange which is growing well, can give good competition to IEX. So I think such pockets are still there with this value and probably decent upside over the next 1 or 2 years.
Right. Sudeep, can you come in on the cement space? How are you looking at trends here? If you could also possibly talk to us about Ultratech Cement, if you have any sorts of reading here, because well, to remind our viewers, we did have earnings yesterday, and Ultratech Cement off late has done reasonably well if you consider what is done over the course of the last 6 months or the last 3 months. Today, of course, it's a little bit under pressure, but don't forget that the earnings had also come in yesterday. And, it had a positive reaction. Today, we are looking at some amount of weakness, currently around the 10,000 mark. What's the way forward here, Sudeep? Sudeep, I believe you are on mute. If you could just unmute yourself and go ahead.
Yeah. See, if you see Ultratech, what has happened is that the stock has had a very good rally from, say, the lows of October, from roughly around 8,200 till about 10,500. And now it's just 15-20 point, correction is in the last 15 to 20 days, what we have seen is the stock has retested 90 and 900 levels. But once again, post the results yesterday, the stock has managed to reclaim its 10 as well as 20-day exponential moving average, and it on a daily as well as weekly charts, if you see, there are important support levels closer to 9800, 9750. So even in the last 7 days, there have been 2 to 3 times where this zone of 9750, 9800 has got retested, and once again we have moved above that. So yesterday the results were fairly good. Now today we have just seen some kind of a profit taking from higher levels. But overall, till this zone of 98.50, 98.30 is not broken, the stock is on its way towards the new all-time high, which could be about 10,500. So I feel if someone is invested, should stay invested, and if someone is not bought, could use the dips towards 9900, 9950 to buy a stock with a 9750 stop loss, and we could see a new swing high or a new lifetime high here about 10,500 also.
All right, that's the view on Ultratech. Thank you so much, Sudeep, as well as Parthiv, for joining us and for giving us perspective. And particularly, thank you for joining us on a Saturday morning. It has been a novel experience for all of us here as well. We have to slip into a very quick break, but we've got more on the other side, including management interviews of Hindustan Zinc. So do stay tuned.
Well, we have Hindustan Zinc Limited in focus. The company's Q3 numbers beat market estimates. Mr. Arun Mishra, the Chief Executive Officer of Hindustan Zinc Limited, joins us. Hello and welcome, Mr. Mishra.
Thank you so much.
So we'll delve right into the performance. My first question is on the revenue front. In revenue year on year, we have seen a structural decline for another quarter. However, we did notice some sequential improvement. So what are we expecting in trend terms? Is this expected to continue forward? And what will be the key strategies that we are deploying going forward that we should be watching out for?
No, so if you look at revenue on same quarter last year was about 7,600 crores and this year about 7,000 crores. But if you look at sequentially from 6,600 to 7,000 crores, so it is mostly 99% of the fall compared to quarter 3 of last year is due to the LME. Since the LME was lower, so correspondingly, this could have been even far lower. The revenue would have been far lower. We could make it up by reducing our cost by about $200 per ton.
Okay, we'll do come back to the LME question, but before that I have another question, which is for the cost of production for zinc. So now that has been on a declining trend for the 4 quarters now. So again over here, what strategies are we deploying to ensure this trajectory continues and it remains sustainable? So A is one that you have mentioned in the presentation is the softening coal prices, but what I want to focus on is the debottlenecking measures that we are taking that is going to be driving the operational efficiency.
So one of the principal reasons of cost reduction is the structural changes in the way we consume coal in producing power. Our power plants are designed to consume about 23 to 30% of domestic coal only. We have debottlenecked the power plant ash handling capabilities, including the ESPs. So now the power plants can go up to 45% to up to even 60% of the coal mix can be domestic coal, which is high ash and low cost coal. And so even quarter 2 altogether, we had about 45% of domestic coal consumed. In quarter 3, we could get about 30% domestic coal in our coal mix. And accordingly, the power cost is lower and hence, of course, overall cost has come down. But that's not the only one. Along with that, we have worked on the consumption norms, improving process efficiencies, consumption efficiencies. We have renegotiated all our contracts to reduce contract cost by various mechanisms of either increasing the time period of the contract, redefining the scope of the contract, maybe carrying part of the risk on our operations and things like that, which has improved our cost. And one of the biggest area of cost reduction also we have worked on is mining with better accuracy, so that we don't need so much of mine development, and we have improved our grade. And every 0.5 increase in grade also reduces the cost by substantial margin. So if you look at the grade-wise from something around 6.5 or so last year, we are about 7.3 or 7.4 in the grade of zinc that we are mining. So that also helped us to reduce cost.
All right, that was quite insightful. Now coming to the zinc prices that have been quite a focus. So the zinc prices saw a sequential improvement to about $2,500 per ton. But when can we expect this number going back to the 2,800 to 3,000 historic range it was in earlier? So do we still expect this number to stay range bound for another quarter as well, or do we see some signs of recovery in the international markets now?
In my own understanding of the international market, this price will remain same around 2,500 to 2,550 in the current quarter. We expect the Chinese economy to bounce back. If that happens by quarter 1 of next financial year, we can expect a price go up to $2,800 per ton. Of course, European economy is not firing back. If that comes back to life, the consumption in Europe increases, then we can see it touch about $3,000 a ton. You have to wait for maybe another 2 or 3 quarters for that.
Okay, so another 2-3 quarters on that front. But now, Mr. Mishra, I want to talk about the roaster. The company had invested a new roaster in the Devri. So in what time frame are we expecting the commissioning of this roaster, as this is in line with the company's target to reach about 1.25 million tons of the mine metal target it has set?
No, so this roaster should come into operation by quarter 4 of this the next financial year. So that means about January to March quarter in 2025. So that then we should get the full benefit of this in the subsequent financial year.
Okay, and in what time frame are we seeing the 1.25 million target that we have highlighted?
So 25-26 we should get 1.25 million ton kind of a number.
Okay, okay, all right. Now moving on to the silver segment. So silver segment revenue mix stands at about 20%, but if you look at the profit mix, it is about contributing about 45% over there. So now we have you had highlighted earlier about the ramp up of the new fumer, but what kind of revenue mix are we looking at going forward? And just another follow up on that, do we see any kind of revision in our guidance as we are very close to achieving the 725 to 750 tons that was highlighted for the year end?
No, so right now we are not revising the guidance simply because the fumer, although commissioned, it is going through the teething issues and all that. So we feel that fumer will be fully stabilized and will start operating at the rate of producing 30 tons of silver per annum by this Q4. So we will get maybe a benefit of maybe 5 or 6 tons of additional silver this quarter. But going forward next year, we'll get a full benefit of additional 30 tons of silver. If that becomes so, then whatever number we close at this year, we will add another 30 tons to it. Now the silver, the way the costing is done, it will remain low. The revenue, it depends upon the price of silver. So I hope the silver being a very sought after metal in India as well. So the prices will continue to be moving northwards even next year. So hopefully, and the whole global focus on renewable power, solar energy will push up the price of silver in the coming days as well.
All right, just a follow-up on that. There were talks about setting 3 more fumers in the last quarter in your conference call. Can you share some progress on that front?
No, so we have launched inquiries and various companies are in talks with us, and we hope to close the order by say February end or so of this quarter, so that construction can begin by early April or May, depending upon the regulatory clearances and all that.
Okay, so February end of this month in the Q4. All right, so now I want to talk about the recent developments of the corporate restructuring plan you had indicated earlier that included about creating about 3 different companies. So how are we faring on that front?
No, so we have done the study of these possibilities and what does it imply for the company and what are the likely gains or losses, whatever may be. That study is complete. Study report has been placed before the individual prime shareholders, which is Government of India as well as Vedanta Limited. Both are considering going through the reports, and they are, especially in case of Government of India, they require multi-department clearances. The process is in place. And I'm sure by next board meeting, we will hear some good news. See, because the fundamentals of this demerger is the ownership pattern of the prime shareholders does not change at all. So whosoever is currently 29.5% shareholder with the Government of India will remain so in the new entities as well. So dividend distribution, nothing changes. All that changes is the market cap of the individual companies. Added together will be better than the market cap that we have. We expect from various studies about $3 to $4 billion of market cap being unlocked. If that happens, then divestment of shares from Government of India will also be easier. It will be easier to divest part of the silver company as well as part of the zinc company, because 2 different set of shareholders would like to acquire those shares. So all reasons are positive, and let's hope for the positive news by next board meeting.
So by next board meeting is the call. Well, that was the final question. Thank you so much for joining us and sharing your perspective on Hindustan Zinc. Thank you again to join NDTV Profit.
Thank you so much.
Welcome back. You're watching India Market Open this Saturday morning. Let's take a look at the markets. And in fact, the benchmark indices have given up just a tad bit of ground. And you have the benchmark Nifty 50 that is trading with gains of just about 0.1% or thereabouts. And that texture has changed over the last 15-20 minutes or so. Among the key indices that are moving in trade, you have the IT index that's just wobbling a tad bit. It is down about 0.2% or so. And a few of the stocks that are under pressure are the likes of Wipro, which is down about 1.5% at this juncture. But you also have the likes of TCS, which is down about 0.25%, and HCL Tech, which is down about 0.5% or thereabouts. But the key loser continues to be HUL, which is down about 2.8% or thereabouts on account of a bit of a disappointing third quarter. Volumes only grew about 2% compared with the growth of 5% in the previous quarter. And though there was an increase in the gross margins to the tune of 400 basis points, that didn't translate to the EBITDA margins because of a higher ad spend. So let's talk about the numbers and the outlook going forward as well, because you're seeing a number of brokerages that are coming out and in fact downgrading their expectations on the stock on the EPS front. We've got Kaustubh Pavaskar, DVP Fundamental Research at Sharekhan joining in. Kaustubh, thanks so much for joining in on a Saturday morning. What was your take on the numbers? Was the volume performance the biggest disappointment?
See, numbers were below our as well as street expectation. Volume growth of 2% was largely in line with what we and street were anticipating for the quarter. But there was not much bit of improvement in the volume growth trajectory, what we have seen for past 2 quarters. In fact, this quarter, there were some anticipations, and even the management commentary in the earlier quarter indicated that festive might bring in some cheer for consumer good companies, but it was not seen. Rural consumption continues to remain weak, and that continues to put pressure on the volume growth of companies like HUL, where almost half of their revenues is coming from rural India. And once rural is back, I think we should see, volume growth trajectory improving in the quarters ahead. The important factor over here is the 75% of the portfolio has achieved mid-single digit volume growth. So the food and refreshments category, because of the pricing inflation, there we have seen volumes declining by low single digit. But net, the volume growth of 2%, I think it is in line with what we have seen in past few quarters.
Cost of that gross margin expansion of about 400 basis points, I think that was expected because of the benign commodity prices or the improvement in that metric, right? But what does that translate to going forward? You saw a bit of a scrimping of the EBITDA margins because of the higher ad spend, and at the same time you see a little bit of pressure on the volume, so that requirement to bolster sales from that end is unlikely to go anywhere.
See, gross margin expansion was expected mainly because of the benign input prices, and the company is investing behind advertisement and promotional expenditure from the future perspective, because most of these ad spends have been invested behind the innovations what they are doing in their portfolio. And that will continue. We have also seen in this quarter the premiumization strategy working for them, and premium products growing by around 2.5% compared to the mass products. Mass product categories, I think once rural is back, I think those, that particular segment will also come back on track in terms of volumes. So I believe that the investment behind brands will continue, considering the innovation what the company is doing in its product portfolio in various categories, and also premiumization as a strategy working well, and I think more ad spends would go behind that as well. So I think ad spends will continue. Company is focusing on improving its gross margins to pre-COVID level. Currently, they have come to the level of pre-inflation, where we have seen last year the inflation going up significant for the raw material cost. So gross margins have come to pre-inflation level. The focus is to improve it to pre-COVID level, and if that happens, I think along with the better mix and premiumization, I think operating margins would also improve over the period of time. So they are expecting modest kind of margin expansion in the medium term.
Very quick, 5-second answer to this question, Kaustav. We're running out of time. What is your call on HUL? What target do you have? Have you adjusted that at all?
We have a buy rating on the stock and we have a price target of 2,910. The valuations look to be reasonable considering the underperformance in past 1 year. So I think we should expect things to come back on track once volume growth recovers.
Thank you so much, Kaustav, for joining us this Saturday morning. Now, turning to the auto ancillary space, and one of India's leading tyre manufacturers, SIAT, has launched its new tyre range. And in fact, Mahima spoke with my colleague Mahima spoke with the company's Managing Director and Chief Executive Officer Arnab Banerjee on the new launch and the demand that the company is seeing in the tyre space. Listen in.
Yeah, so as you know, the two-wheeler tires, the two-wheeler market in India is mostly commuter-driven. So it's a old technology bias tire. And at the top end, there had been a little bit of radialization using fabric radial. But for these kind of new applications, you need tougher tires with a steel belted radial. So the advent of steel belt is a completely new technology as far as SIAT is concerned. And they are meant for very, very high performance usage on highways as well as off-road.
How big is the market and what does the demand look like?
So this is a nascent emerging market at this point of time with rising affluence and better road infrastructure. People are doing leisure biking as well as adventure biking. So cruising and along highways, going on those Ladakh expeditions are becoming more and more common in groups or even solo sometimes. So this market today is about, let's say, 3% of the total market. But this is going to increase disproportionately as we go forward.
Okay. And will this be only for the domestic markets or do you also plan to export these tires?
So we have started off making these tires for the domestic market, OEMs, as well as the aftermarket. And we are looking at international markets, but immediately there are no plans to do so.
What is the price range and how is it different from the other motorcycle tires that you're already selling? And how does this impact your margins? Will it be margin accretive? Yes,
it will be definitely margin accretive in the aftermarket where the margins will come from. So an average price of this tire could be about maybe 8 to 10x of a normal bias tire. And it is definitely margin accretive. And the technology is also completely new. We have set up a new facility for this. A lot of R&D effort and resources have gone into this. So we are pretty bullish about this.
All right, and the tyre company is seeing its share price up as much as 1.7% as we speak. That brings us to the end of this particular edition of India Market Open, but there's lots of coverage of the markets over the course of the day. As you know, we're live through the day till close at 3:30. So do stay tuned.